Alrighty, welcome to episode 3. Last episode, we talked about the basics and the groundwork or framework that you're going to need to progress through these videos. In this video, we're going to talk about the market efficiency paradigm, smart money, or the banks versus dumb money, which is retail traders like you and I, how the market actually works, liquidity and order pairing, and then we're going to talk about news and macroeconomic trends. So what is smart money and what's dumb money? And what is the market efficiency paradigm? This is a little illustration from ICT himself on one of his videos where he talks about how the market actually moves. When you first start learning how to trade or invest in the stock market, one of the more common things that people are going to tell you or that you're going to hear is the market is controlled by buying and selling pressure, which is not true at all. It is not true at all. Market does not move on buying and selling pressure. The market does not move based on you and I buying or selling. The market moves based on these individuals here. Smart money or banks. It's typically the banks, big banks that have the liquidity or the money to move the market around, because retail traders like you and I, we do not have the liquidity or the power to move the stock market up and down. No matter who tells you that or how many times you've heard it, it's just not true at all. Speculative, uninformed money are individuals that are not in the stock market in a professional capacity. They're just everyday people like you and I. We don't work at a bank. We don't work at a fund. We don't manage a fund, right? This is not those individuals. This is everybody else, retail traders. And we are the willing and or unwilling liquidity. Whether you are with the smart money or not is really depending on what you're trying to do, because if smart money is bringing the market up and you're trying to short it, you're going to get wrecked. Likewise, if they're bringing the market down and you're trying to go long, you're going to get wrecked. So that's where the willing or unwilling liquidity part comes. The market efficiency is based on what smart money is trying to do. Smart money needs liquidity, us, in order to move the market up and down because they're trying to move so much money. Now, if you don't believe me, here is Jamie Dimon from Chase Bank.
If you want to do what JP Morgan does, we move $10 trillion of money around the world every day. We bank some of these companies in 30 countries. We bank countries. We bank the World Bank, the IMF. We bank the United States government. You have to be big. You can't do those things and be small. I applaud the small banks. We're the biggest bank, community banks and regional banks and stuff like that.
There you have it. Chase moves trillions of dollars in a single day. The market efficiency portion here mainly pertains to the smart money or the banks. If you understand what smart money is doing, then you can get in line with where they are taking the market. And moving forward throughout this course, you're going to see things, and I'm going to explain some things, that the market is not controlled by buying and selling pressure as you and I were led to believe. No matter how many times you've heard it, how many people tell you, the market just does not move based on buying and selling pressure. And even from a regulatory standpoint, right? Think of all of the people, countries, states, funds that rely on the stock market for things like pensions, retirement funds, 401ks, even just like investing, like foreign markets or countries invest in the dollar or gold. Other countries invest in whatever another country offers, right? Just from that standpoint and how much things are intertwined together, they're not going to leave that kind of stuff to everyday people like you and I to control, right? They're going to do it in a way that benefits them. So that's where the market efficiency paradigm comes in. They're trying to do stuff and they're using us as a means to do that. If you don't believe me, here's a clip from JJ, who is a former market maker. I highly recommend you watch the rest of the entirety of this video, because he talks about things that he used to do as a former market maker and how the market actually works. I'll put the video in the description so that you can watch it later.
I see so much a tendency to overcomplicate trading. And trading is all about supply. If there's no outside supply, then it's just inside supply, which is moved back and forth by wholesale, because that's their business model, right? They take it up, sell it to us. When we get tired of holding it, they take it down, buy it back, and they'll take a market up and hold it up to sell what they bought cheaper. And nobody understands that. You've got to understand there's somebody taking the other side of your trade. They paid your brokerage house to take the other side of your trade. They are trading against your order flow. So for example, you trade at Ameritrade or Scottrade or one of these places or E-Trade, your order goes to Citadel, right? If you're buying 1,000 shares of ABC and they don't have 1,000 shares, they will short it to you, right? That is their business model. It is called providing liquidity. Otherwise, what would happen was if you went to buy a $5 stock and there was no market maker providing liquidity, you'd get 100 at 5, 100 at 520, 100 at 530, 100 at 550, and 100 at 6, because there'd be nobody that willing to sell it to you.
Right.
So shorting to retail is one of the most misunderstood concepts that retail traders have and don't know anything about. The market maker's job is to short to you. He's not doing it because it's malicious. He's doing it so you can get your stock at the price you want. Now, that entails risk, right? So the market maker is at risk on that stock, and he has to go to the bid to cover. Now, they do this millions of times a day. Like right now in the S&P 500 ES, inventory is long. Right? So when inventory is long and there's no upside continuation, the market maker who is selling the stock up there to you or whatever, they're going to pull the bids, run the stops, get everybody out, and then take the market back up again later. Right? So you have to understand the mechanics of the business model. And then there's sometimes like in choppy trade means it's a washing machine. Yep. We're trying to build a position. So we're cleaning up, cleaning down. It's like a vacuum cleaner.
There you have it. So if you didn't understand what I was explaining just a few minutes ago, I hope that short clip from JJ explained it a lot better than I can and in a way that you can understand it. Again, the market is not controlled by buying and selling pressure. It is not controlled by the speculative, uninformed money. It's controlled by the smart money, and they use us as a means to get the market where they want in order to do their business. Now that we've spoken about the market efficiency paradigm and how smart money uses dumb money to do what they want, we're going to go into how the market actually works. So liquidity / order pairing. JJ touched on it a little bit ago in that little clip that I showed, but essentially they accumulate orders by bringing the market up and down, consolidating it in a tight range, right? And then they run it wherever they want it to go. And we're gonna talk about that here in the next video, where we talk about the IPDA, or the interbank price delivery algorithm. But for the sake of this video, we're just gonna talk about liquidity and order pairing. As you can see here in this little chart, this is the daily chart for the NASDAQ futures index. Building on what JJ was talking about, there's always someone on the opposite end of the trade. So if you're selling, there's someone buying. If you're buying, there's someone selling. So as retail is buying, smart money is selling to the retail to get out of their position, because at this point they're selling it for profit. And then as they're bringing the market back down, as retail is selling, smart money is buying, because now they're reaccumulating, right, to run it back higher. So they run it up to sell to us, then they run it back down to buy back what they just sold, and then they run it higher. So it just repeats the process. So like JJ said, they do that millions of times a day. This is a daily chart, however. So as you can see on a much longer time frame, this is exactly what they're doing. So they run it up, they run it down, they reaccumulate, right? Over here, they're chopping it up like a washing machine, and then they're running it up higher, right? Come back down, take a little bit of sell stops, run it much, much higher. And this back then was when I think NVIDIA was running as well, right before they did a split. And then look at how deep they retraced it. And then now we're about to hit all-time highs again. That's essentially what liquidity or order pairing is. Whatever you think is happening, it's usually the opposite of what smart money is intentionally doing. And that's where the market efficiency paradigm comes from. Whatever they're getting retail to think, they're actually doing the opposite. So whenever people are getting, happy or euphoric, or, the old saying of, when your teacher starts mentioning stocks, it's probably time to sell, right? Back when GME, AMC was running, yeah, people did make money off of it until they flipped it and they reversed it on everyone. And then now look at that. Everyone's holding the bag, right? And it's the same thing with all the other stocks. Whenever people are starting to get ecstatic or euphoric or very, very bullish or very bearish on something, you should probably start being cautious with it, right? It's the same thing with NVIDIA. NVIDIA was running a lot higher before as well, right? And then they did their split, and then now they are trading low. Well, now it's almost back to all-time highs. But before they sank it, right, everyone was thinking NVIDIA was just going to keep going. But the people that know what's actually going on, they were kind of skeptical, right? They're like, I don't know, I'm not going to buy this high because it's kind of sketchy, kind of sus, right? That is what order pairing is. That is what liquidity is. That's how the market moves. That's how the market works. That's what moves the market, is just liquidity, because the big banks are moving trillions of dollars a day. They need the liquidity in order to do that. That's where the willing or unwilling liquidity providers like you and I come into play. And that's how the market efficiently moves. It's not for our benefit, it's for the benefit of smart money and whatever agenda they're trying to push. So now that we got that out of the way, we're going to talk about the news and macroeconomic trends. In that same video of the clip from JJ, where he talks about market makers and providing liquidity and shorting to retail, there's a little clip in there where he talks about how market makers use articles or headlines or news to move the market. If the news is painting a certain idea for retail to believe, that automatically starts throwing red flags in my mind, right? If they're like, oh, NVIDIA's bullish, so-and-so analyst upgrades NVIDIA's stock price to 250 from 230, right? If they're doing stuff like that, or like, AI, NVIDIA is the next, AI pioneer for the next few years to come. Whenever I see headlines like that, the warning sign is already flashing in my head, because that is intentionally done by market makers to get retail to think a certain way. And it builds into the market efficiency paradigm and the order pairing, right? They're wanting people to buy because they're probably wanting to sell their position up higher so that they can drop it on them later. And as we go into the rest of the videos in this course, you'll see that they actually use the news to get the market where they want it to go. This is a site that I use to track economic events for the upcoming week. I look at it every single weekend before the week even starts, because I want to see where the market makers are more than likely going to move the market. I really only care about the orange and the red, the high impact and the medium impact. I don't really care about low impact or the ones that have no impact at all. So if you apply that, now you can see what days of the upcoming week will have medium to high impact news. So just looking at this right now, I know that Wednesday is probably going to be a low probability day for the market to move, because there's no medium or higher impact news that day. There's medium on Monday and Tuesday, so maybe the market might move those days, but I'm mainly focusing on Thursday, because Thursday has red folder news, and then Friday has medium impact news as well. But again, the bulk of my trading is probably going to come on Thursday when they have the 3 red folder news at 8:30. I'll show you an example going into the rest of the videos here when it starts to get really, really interesting, how you can trade and how the news affects what the price does throughout the week. That is it for this video. I will see you all in the next one. Hope you learned something. Hope I started to open your eyes into how the market actually moves and who actually controls the price, and how we're just pawns in the grand scheme of things. But I will see you all in the next video. Bye, everyone.